As of late 2024, the global silver market has entered what analysts describe as an acceleration phase, a period where the physical reality of the metal finally breaks away from the digital price discovery of the paper markets. We call this the 0 hour. Right now, evidence of this shift is mounting at the U.S. Mint. Reports from primary authorized purchasers indicate that lead times for American silver eagles have begun to stretch beyond historical norms, signaling a return to allocation status. While official mint production figures for the year show steady volume, the secondary market tells a different story. Premiums are beginning to detach from the spot price, and physical delivery is becoming a game of patience rather than a standard transaction. This isn't the first time we've seen this pattern, but the context has shifted. In 2008, as the global financial system buckled, physical silver became nearly impossible to source at spot prices. In 2020, the pandemic-driven silver squeeze saw retail inventory vanish overnight, creating a 30% gap between the paper price and the cost of a physical coin. Today, the situation is more precarious, unlike the temporary panics of 2008 or 2020. Current industry data suggests the present shortage is being driven by a structural deficit. When the U.S. Mint serves as the world's premier producer of silver bullion and cannot meet immediate demand, it acts as the ultimate early warning system. It is the moment when the paper burning starts to manifest in the real world. The 0 hour is defined by this specific phenomenon, the physical disconnect. When the price on your screen stays at $30, but no primary dealer can fulfill a high-volume order for immediate delivery, the paper price has become irrelevant. This is the acceleration phase. We are no longer speculating on a future event. We are observing the live decoupling of a market that is running out of physical time. To understand the magnitude of the current market setup, we must look back at the most famous event in silver AS history, the 1980 Hunt Brothers short squeeze. For decades, the story of Nelson Bunker Hunt and William Herbert Hunt has been used by mainstream financial media as a cautionary tale, a warning that those who try to corner the silver market will inevitably be crushed by the exchange S-power to change the rules. However, when we overlay the technical data of 1980 against the reality of 2024, a different narrative emerges. We aren't seeing a repeat of the Hunt brothers. We are seeing something far more dangerous for those holding short positions. In 1980, silver AS parabolic run to nearly 50 per ounce was driven by two wealthy individuals attempting to use the COMEX to force delivery. This 10x increase in leverage is the foundation of what market historians are now calling the ultimate bear trap. In 1980, the COMEX was able to break the squeeze by implementing liquidation-only trading rules, effectively banning new buy orders and forcing the price down. But that strategy relied on one critical factor. The COMEX was the only game in town. Today, the Shanghai vacuum has eliminated that monopoly. When the U.S. paper markets attempt to suppress the price through high-frequency trading and synthetic naked shorts, the physical metal doesn't just sit in a London vault. It migrates to the east, where the Shanghai Gold Exchange maintains a consistent physical premium. Looking at the long-term technical charts, silver is currently completing a consolidation pattern that has lasted over 44 years. In technical analysis, the longer the consolidation, the more violent the breakout. Since the 1980 peak, silver has undergone a massive cup and handle formation on the monthly time frame, a pattern that suggests the recent breach of the 30 resistance level is not just a temporary spike, but the beginning of a structural revaluation. Historical data from the Federal Reserve Bank of St. Louis, Fed, regarding the M2 money supply provides the most sobering contrast. In 1980, the total U.S. money supply was a fraction of what it is today. If we were to adjust the 1980 silver peak of $50 for the sheer volume of currency debasement and inflation seen over the last 4 decades, some mathematical models suggest a relative value exceeding $200 per ounce. This highlights the bear trap. The current spot price is not reflecting a surplus of silver. It is reflecting an artificial surplus of paper contracts that cannot be fulfilled by the dwindling physical inventory. Market participants often point to the 2011 peak as proof that silver cannot sustain these levels. However, in 2011, the global industrial demand for silver was centered largely around photography and silverware, sectors in terminal decline. As of late 2024, the fundamental landscape is unrecognizable. Silver is now a critical strategic industrial metal essential for the global energy transition. The Silver Institute's recent projections indicate a persistent structural deficit, where annual mine supply fails to meet industrial demand by hundreds of millions of ounces. In the 1980 era, the Hunt brothers were the sharks the system had to kill. In 2024, the sharks are sovereign entities and industrial giants who are quietly absorbing the registered silver inventory from Western vaults. When the paper-to-physical ratio is 300 to 1, it only takes a 0.3% request for physical delivery to effectively default the exchange. The shorts are currently betting that they can use the same tactics used against the Hunts, margin hikes and paper dumping, to keep the price suppressed. But they are ignoring the historical precedent of the decoupling. We are witnessing a moment where the technical indicators are signaling a massive breakout, while the fundamental paper leverage has reached a breaking point. This is why the current era is 10x more explosive than 1980. Back then, the Hunts were trying to corner the market. Today, the market is cornering itself. The exit is getting smaller, the paper claims are getting larger, and the physical metal is simply gone. This isn't just a trade anymore. It is the closing of a 44-year technical loop. To understand why the current silver market is 10 times more explosive than the 1980 Hunt Brothers era, we have to look past the ticker tapes of New York and London. We have to look toward the east, specifically to an entity that has spent the last 2 decades preparing to dismantle the Western monopoly on price discovery, the Shanghai Gold Exchange, or SGE. This is the heart of what macro analysts now call the Shanghai vacuum, a geopolitical siphoning mechanism that is systematically draining Western vaults of physical metal. As of late 2024, the global silver market is witnessing a tectonic shift in where the real price of metal is determined. For nearly a century, the LBMA in London and the COMEX in New York have been the undisputed kings of precious metals. However, these Western exchanges operate on a foundation that is increasingly viewed by Eastern sovereigns as a paper casino. To understand the Shanghai vacuum, one must first understand the fundamental difference between a cash-settled exchange and a delivery-based exchange. In the Western model, specifically the COMEX, silver is primarily a financial instrument. It is traded in the form of futures contracts, promises to deliver metal at a later date. According to historical CME Group Metal Warehouse Deposits reports, only a tiny fraction of these contracts ever result in the actual movement of physical silver. Most participants are speculators who roll their contracts or settle in cash. This allows for the creation of massive paper leverage. As of the fourth quarter of 2024, industry reports indicate that the ratio of paper silver traded to the actual physical silver held in registered vaults, those available for delivery, has reached unprecedented levels, with some estimates suggesting a disconnect of over 300 to 1. The Shanghai Gold Exchange, established by the People's Bank of China in 2002, was designed to be the antithesis of this system. From its inception, the SGE was built as a physical-first market. On the SGE, when you buy silver, you aren't just trading digits on a screen. The exchange is built to facilitate the actual withdrawal and movement of bullion into the hands of the buyer. While Western exchanges prioritize liquidity and price discovery through high-frequency trading of synthetic contracts, the SGE prioritizes the physical integrity of the supply chain. This brings us to the Shanghai arbitrage gap. At the time of this recording, a persistent and widening premium has emerged between the silver price in London and the silver price in Shanghai. While the spot price in the West might sit at $30, the physical price in Shanghai often trades at a significant premium, at times reaching 4 SOR, 6 SORs, or even 8 SORs higher per ounce. In a globalized economy, this creates a mathematical vacuum. Think of it as a pressure differential in the atmosphere. Capital seeks the path of least resistance and highest return. Traders and sovereign entities are currently observing this gap and performing a physical arbitrage. They buy the cheap paper silver on the COMEX or LBMA, demand physical delivery, which the Western exchanges are legally obligated to provide if the contract is held to maturity, and then immediately ship that metal to the East to sell it at the higher Shanghai price. This isn't a theory, it is a visible phenomenon in the data. According to recent tracking of silver inventories in London's LBMA vaults, we have seen a multi-year trend of consistent outflows. According to the Silver Institute's Q3 2024 interim report, global silver demand is on track to outpace supply for the 4th consecutive year. But look closer at where that metal is going. It is not staying in Western retail hands. It is moving into the industrial and sovereign vaults of the East. The geopolitical timeline of the SGE reveals a deliberate strategy. In 2014, China launched the Shanghai Gold Exchange International Board, SGEI, allowing foreign investors to trade in yuan-denominated contracts backed by physical metal. This was a direct challenge to the US dollar's hegemony in commodity pricing. By 2023 and into 2024, as the West weaponized the dollar through sanctions, the motivation for Eastern nations to move their wealth into open hard assets through the SGE moved from a financial preference to a national security priority. This vacuum is being fueled by a structural shift in industrial demand that the Hunt brothers could never have imagined. In 1980, silver was a luxury and a speculative play. Today, it is a strategic industrial requirement. China currently dominates the global production of solar photovoltaic panels and electric vehicles. According to industry data, the solar sector alone is projected to consume over 20% of the world or our annual silver supply by 2025. China is not just buying silver because they want the price to go up. They are siphoning it because their industrial future depends on it. They cannot afford to rely on a paper price in New York that may not guarantee physical delivery during a crisis. This leads to the registered versus eligible trap within the COMEX. When you look at CME Group warehouse reports, you will see two categories. Eligible silver is metal held in vaults that could be made available for delivery, but it is owned by private entities, banks, hedge funds, or individuals who have no intention of selling at current prices. Registered silver is the only metal actually available to satisfy futures contracts. As the Shanghai vacuum continues to pull metal eastward, the registered inventories in the West have been trending toward historic lows. Analysts observe that we are approaching a delivery convergence. If the Shanghai premium stays high enough for long enough, it incentivizes the total depletion of Western registered stocks. When the 0 hour arrives and a major industrial player or a sovereign wealth fund demands delivery on the COMEX, the exchange may find that the eligible owners refuse to sell their silver at the suppressed paper price. This is the moment the paper burning becomes a conflagration. In this hypothetical wealth migration case study, the SGE represents the physical exit. In the West, the exit is a narrow door of cash settlement. In the East, the exit is a wide open vault of physical delivery. When the paper to physical ratio is 300 to 1, the system relies entirely on the hope that nobody asks for their metal. But the Shanghai Gold Exchange was built specifically to ask for the metal. By understanding the mechanics of the SGE, we see that the current price action is not just about inflation or interest rates. It is about a fundamental relocation of the world's most undervalued strategic asset. The West is selling its insurance policy, its physical silver at a discount to maintain the illusion of a stable paper price. The East is the buyer, and they are using the Shanghai vacuum to ensure that when the 44-year consolidation pattern finally breaks, the physical metal is no longer in London or New York. It will be in the vaults of the nations that understood the difference between a digital promise and a physical reality. This isn't just a market trend. It is the closing of the Western silver era and the beginning of a new Eastern-led physical standard. As we move into the final months of 2024, a phenomenon is occurring that traditional financial models suggest should be impossible. We are witnessing the death of the dollar-pegged silver price. For decades, the global valuation of silver has been dictated by the US dollar through the high-frequency trading floors of the COMEX and the LBMA. But the persistent $8 or arbitrage gap between Shanghai and New York isn't a temporary market glitch. It is the first visible crack in what macro analysts are calling a price discovery revolution. To understand why this gap is terminal for the current system, we have to look at the mathematical lie of the current spot price. Historically, the dollar has acted as the yardstick for silver. When the dollar is strong, silver appears weak. However, this relationship relies on the assumption that the dollar is a stable unit of account. When we apply a currency-adjusted lens to silver's value, the current spot price begins to look like a structural anomaly. If we examine historical data from the Federal Reserve regarding the M2 money supply expansion since the 1980 peak, the numbers reveal a sobering reality. In 1980, when silver reached its record high of $50, the total U.S. money supply was approximately $1.5 trillion. As of late 2024, that same money supply has ballooned to over $21 trillion. Analysts suggest that if you adjust silver's 1980 peak for the sheer volume of currency debased over the last 4 decades, the relative value doesn't just pass $50, it screams toward a new equilibrium. This is the foundation of the $86 price target. It isn't a speculative guess. It is a mathematical projection based on the restoration of silver as an historical purchasing power relative to the total circulating currency. The 8.0 premium in Shanghai is the market's way of rejecting the dollar peg in real time. As of this recording, the Shanghai Gold Exchange is effectively acting as a global revaluation engine. Every ounce of silver that is bought at the suppressed New York price and siphoned through the Shanghai vacuum is a direct strike against the dollar's ability to act as a price setter. Industry reports indicate that we are approaching a phase shift. In this scenario, the paper markets in the West eventually lose their ability to attract physical metal because the currency-adjusted value in the East is simply too high to ignore. This is the essence of the price discovery revolution. The 86 target represents the point of monetary convergence, where the paper suppression can no longer bridge the gap between a debased currency and a finite physical asset. When the world realizes that the dollar-pegged price is an artificial construct maintained by paper leverage, the scramble for physical metal will likely bypass the digital ticker tape entirely. We are no longer looking at a simple market rally. We are witnessing the birth of a new physical-led standard for silver. In this new regime, the prices aren't what a computer in Manhattan says it is. It is Sino-West, what the last available ounce of physical metal is worth to a nation that needs it. While the Shanghai vacuum operates at the sovereign level, siphoning thousands of tons of silver from Western vaults to Eastern industry, the individual investor experiences this crisis through a much more mundane yet terrifying local trigger: the sold out sign at the local coin shop. To understand the true fragility of the silver market, we must step inside the institutional machinery of the United States Mint. As of late 2024, a recurring phrase has haunted the precious metals market: the 8-week delay. When demand spikes, the Mint frequently issues statements citing supply chain disruptions or temporary production pauses. To the casual observer, this looks like a logistical hiccup, a simple case of a factory falling behind on its orders. But if we analyze the specific physics of silver blank production and the legal mandates governing the Mint, it becomes clear that this delay is actually a systemic lie designed to mask a physical default. Under Title 31 of the U.S. Code, specifically Section 5112, the Secretary of the Treasury is legally mandated to mint and issue silver bullion coins in quantities sufficient to meet public demand. This isn't a suggestion, it is a statutory requirement. Yet, for years, the Mint has repeatedly moved to an allocation system, effectively rationing the number of American Silver Eagles available to its network of authorized purchasers. When the Mint claims it cannot meet demand, it usually points to a single bottleneck: a lack of silver blanks, also known as planches. To understand why this is a systemic failure, we have to look at the physics of the supply chain. The U.S. Mint does not typically manufacture its own silver blanks. Instead, it relies on private vendors, primarily companies like Sunshine Minting, to take raw silver bars, melt them, roll them into precise sheets, and punch out the circular discs that eventually become coins. This process is not a digital transaction. It is heavy, energy-intensive metallurgy. In a steady-state economy, this industrial pipeline works. But as of the current market cycle, the physical constraints of this pipeline have become a cage. Analysts suggest that the industrial capacity to produce high-purity silver blanks is finite and currently operating at near maximum utilization. You cannot simply print a silver planche. You need specialized rolling mills, annealing furnaces, and hydraulic presses. These are multi-million-dollar pieces of equipment with lead times of 18 to 24 months just for installation. When the U.S. Mint cites an 8-week delay, they are essentially admitting that their just-in-time inventory model has hit a wall. In the world of physical commodities, an 8-week delay is an eternity. It is the industrial equivalent of a bank saying, "We have your money, but you have to wait 2 months to withdraw it." In any other financial context, this would be called a halt or a suspension of redemptions. The lie lies in the cause. The Mint often blames unprecedented demand, but industry reports indicate a more systemic issue: The mint is competing for the same raw silver as the solar industry and the Shanghai Gold Exchange. When the Shanghai-London arbitrage gap sits at 8 toin or horses, the raw silver that would normally be sold to a blank manufacturer in Idaho or Nevada is instead being diverted to the east. The blank shortage is not a manufacturing problem, it is a sourcing problem. The silver simply isn't there at the price the mint is legally allowed or willing to pay. This creates what macro analysts call the local trigger. If a true run on the banks were to occur, a scenario where even 1% of the U.S. population decided to move their paper savings into physical silver, the U.S. Mint AS production capacity would be mathematically overwhelmed in less than 48 hours. Based on current production sales and figures, the Mint's annual output of silver eagles typically hovers between 15 million and 40 million ounces. While that sounds like a large number, it represents less than 0.15 ounces for every American citizen. The 8-week delay is a psychological buffer. It is designed to prevent a feedback loop of panic. If the Mint admitted they were physically unable to source enough silver to meet the public's legal right to buy it, the paper burning on the COMEX would accelerate instantly. Instead, they use the blank shortage as a convenient excuse to throttle the exit. This leads to the allocation trap. When the Mint moves to allocation, they only provide a fraction of requested coins to their authorized purchasers, the big wholesalers. These wholesalers, in turn, must choose which local coin shops get their tiny slice of the pie. By the time that silver reaches you, the consumer, the premiums, the cost over the spot price have exploded. As of late 2024, we have seen premiums on silver eagles reach 40%, 60%, or even 100% over the digital spot price during periods of delay. This is the two-tier market in action. On your screen, silver might be trading for $30, but at the counter of your local shop, if they even have stock, the price is $50. The 8-week delay is the mechanism that allows the paper price to remain low, while the physical price reflects the actual scarcity. It is a soft default on the Mint's legal obligation to the public. Looking at the current burn rate of global inventories, the 8-week delay is likely to transition into a permanent state of out of stock. History shows that in a currency crisis, the most valuable assets are the ones that are the hardest to manufacture. You can print $1 trillion bill in seconds. You cannot manufacture a silver blank without a furnace, a mill, and most importantly, the physical silver that is currently being vacuumed into the vaults of the East. When you hear the news that the U.S. Mint has once again halted production or moved to restricted allocations, do not view it as a logistical glitch. View it as a systemic warning light. It is the physical manifestation of the Shanghai vacuum hitting your neighborhood. The Mint is the pressure valve of the Western silver market, and that valve is currently vibrating under a load it was never designed to handle. When the 8-week delay becomes a 24-week delay, the local trigger will have been pulled, and the scramble for the remaining physical ounces in the West will move from a quiet trend to a national emergency. While the U.S. Mint struggles with blank production, a far more dangerous fire is consuming the heart of the Western financial system, the COMEX vaults in New York. To the casual observer, the total silver reported by the CME group looks relatively stable. But if you peel back the layers of the Metal Warehouse Deposits reports as of late 2024, you find a mathematical nightmare. The COMEX distinguishes between two types of silver, eligible and registered. Eligible silver is metal sitting in the vault that belongs to private owners. It is not for sale at the current spot price. Registered silver, however, is the only metal available for delivery to satisfy futures contracts. This is the liquidity of the market. Industry reports indicate that registered stocks have been decimated, falling to levels that mirror the most volatile periods of the 1980 Hunt Brothers era. The Pompersmar's paper burning occurs when we compare these dwindling physical ounces to the massive open interest, the total number of paper contracts promising delivery. Historical data shows that in 1980, the ratio of paper claims to physical ounces was significant, but today's leverage is on a different scale. This is why the $86 price target is viewed by many macro analysts as a mathematical projection based on the restoration of silver's historical purchasing power. If we apply a restoration of reality formula, adjusting the 1980 peak for the current M2 money supply expansion, the result is clear. Once the registered vault hits a critical breaking point, the paper market loses its ability to price the metal. In this scenario, the price must gap upward to a level where owners of eligible silver are finally willing to sell. Based on the sheer volume of currency debasement since the 1980s, that equilibrium point aligns with an $86 valuation. We are witnessing the burning of the paper promise. As the Shanghai vacuum continues to outbid New York, the incentive for bullion banks to move silver from eligible to registered has vanished. Why sell in New York for a suppressed price when you can ship it to the East for a premium? The vaults aren't just low, they are being strategically emptied. If the current burn rates observed in the first half of this year continue, the Western paper price will eventually hit a wall of physical reality. When the vaults finally run dry, the 86 out of dollar target won't just be a projection. It will represent the new floor of a physical-led market. The following framework is for educational purposes and illustrates a historical wealth preservation theory. It is not a recommendation to buy or sell specific assets. This is a hypothetical wealth migration case study, illustrating how the ounces to acres concept functions as the final stage of sovereign wealth preservation. If the mathematical projection of an $86 silver price, adjusted for the current M2 money supply, manifests, the objective for the individual is not to accumulate paper currency, but to lock in that transient value into permanent productive assets. Historically, during periods of systemic currency debasement, the purchasing power of silver against real property tends to compress. While it currently takes thousands of ounces to acquire a single acre of tillable land, a physical decoupling event could theoretically shift that ratio to levels not seen in generations. This is the heart of the sovereign strategy. The framework follows a three-step cycle. First, the liquidity pivot. As the Shanghai vacuum drives the physical price higher, the objective is to monitor the silver-to-land ratio rather than the dollar-denominated price. Second, the wealth migration. This involves the hypothetical conversion of a high-velocity metal into a low-velocity, high-utility asset, specifically productive land. Third, the autonomy phase. By securing acreage with independent water rights and tillable soil, an individual effectively exits the centralized financial grid that is proven fragile under the 8-week delay system. As of late 2024, industry reports indicate that productive land remains the ultimate hedge against a digital-only financial regime. This framework suggests that silver is not merely an investment, but a volatility bridge to the stability of the earth itself. In this scenario, the final resolution to market anxiety isn't a higher number on a bank statement, but the total autonomy that comes from owning the physical ground beneath your feet. As of late 2024, the convergence of the Shanghai vacuum, COMEX depletion, and U.S. mint constraints suggests a multi-layered collapse of the traditional paper-silver market. For those analyzing these historical cycles, analysts suggest three educational considerations. First, evaluate the discrepancy between digital claims and the physical metal available for delivery. Second, monitor the paper-to-physical ratio as a metric for systemic fragility. Third, consider the hypothetical transition from high-velocity metal to permanent productive land. This framework represents a critical window for individual due diligence as the market shifts from digital promises toward tangible autonomy.